Good morning, all the KCGC TV viewers. My name is Dr. Shivam Sarpal, Assistant Professor from Khalsa College of Law, Amritsar. Today I am going to deliver a lecture on significance of financial ratios in the investment decision making. So investors, while taking investment decisions, should conduct some certain decisions like fundamental analysis of the company. This analysis is very much crucial and important as it assists you to make investment decisions in a sound manner. The fundamental analysis includes basically the scrutiny of P&L account, that is profit and loss account, which is now renamed as statement of profit and loss, balance sheet, cash flow statement, fund flow statement, ratios analysis, and many more. Out of these, ratio analysis occupies a significant role in investment decision making. Now, what are these financial ratios? Financial ratios basically conduct the analysis of certain aspects of P&L account and balance sheet to assist the investors basically to take their investment portfolio decisions in a viable manner. Basically, these ratios explain you the viability of the firm in terms of its assets, revenues, incomes, expenses, and certain other obligations. So moving on to these ratios, our first ratio is price to earnings ratio. Price to earnings ratio basically indicates through the formula market price per share divided by earnings per share. Now let's take the example of a company wherein a company, let's suppose, is having a profit of 1000 rupees and is having 100 shares outstanding in its balance sheet. Here shares are means equity shares or the common shares. So the EPS here is rupees 10, and let's suppose that company's share is traded at rupees 100. Now MPS divided by EPS, that is 100 divided by 10, the EPS will be ultimately turned out to be, that is PE ratio will be rupees 10. This 10 means that in order to earn a rupee 1, investor has to pay rupees 10 in the stock market. Rupees 10. The 10 means here that out of these 10 rupees, investor is expecting at least 1 rupee return as its earning. Now, the basic points which needs to consider in this price earning ratio is that the price earning ratio does not remain consistent over the industries. Rather, it tends to vary over the different sectors. Let's say I'm taking the example of two FMCG companies, fast moving goods companies. Let's take the case of HUL, Hindustan Unilever Limited, and Britannia. For example, Hindustan Unilever Limited is having a price earning ratio of rupees 70. On the contrary, Britannia has a price earning sharing ratio of rupees 40 only. So here HUL is treated as overvalued. As the price earning ratio increases, the actual capacity of the firm to increase its profits also increases relative to its market. So the higher the profit earning ratio, the more would be the value of the firm, called as overvalued. The lower is the profit earning ratio, so lower will be the value of the firm, call it as undervalued. So this overvaluation and undervaluation does matters. Second concept which is needs to be considered over here is that the price earning ratios, as I have already told you, that it varies across various industries. So let's take the example of two industries, paper industry or FMCG. The paper industries usually have the price earning ratio of only 7 to 9. That may be 7, may be 8, may be 9. Or the in case of FMCG industry, basically the price earning ratio is remarkably high. It ranges between 40 to 70. That means some companies in the FMCG industries can have EPS of or the price earning ratio of 40, or while others can have 70 also. The next ratio is return on equity. Before explaining return on equity, I would like to explain a relationship it with price earning ratio. Suppose the price earning ratio is having a high trend in case of declining industry. Now what does it mean? Industry is declining but the price earning ratio is increasing. It means that the company is not having good financial position in the future. It can have lesser future earnings in the coming future. But on the contrary, if there is low price earning ratio but in the growing industry, in the promising industry, it means that the company is having good growth potential in its future. Moving on to the return on equity ratio. Return on equity ratio can be denominated with or can be indicated through net income divided by shareholders' equity. It means how much good a company is in giving return to its shareholders or the ultimate investors. Now, let's take the example of return on equity. For example, you are a promoter of the company and you're having 100 rupees as the capital, as the total capital of the company, and you are earning the profits of rupees 20. Now this 20 divided by 100 multiplied by 100 will give you 20% return on equity. On the other case, let's take the case of the another company who is also having rupees 100 as equity base but is earning more profits, that is rupees 40. In this case, the return on equity will be 40%. So as the return on equity moves up, the company's financial performance in terms of profits also moves up. As the return on equity moves down, return on equity, the company's financial position also moves down. This return on equity, like in the case of price earnings ratio, also varies from sector to sector, industry to industry, and in other contextual settings, it can have different assumed ratios. Second point, ROE can be high if there are more debt in its capital structure. That means the company is highly levered. Here, levered means financial leverage. The more would be the debt, the more would be the financial leverage, more is the chances of having return on equity. So, investor must consider this aspect of, you can say, debt, highly levered debt, while considering the return on equity ratio. Now, the third ratio is deals with price to book value ratio. Now, what does the price? Here, price means market price per share. The current market price of the share the company is trading in the market right now, divided by book value per share. Now, what does this mean, book value? Book value means if the company assets are sold in all and all the liabilities have been paid off, whatever the leftover is remaining, the remainder part is known as book value. This book value, I can explain this through with example. Let's suppose the company wants to shut down its business and it wants to sell off all its assets, and the amount which it has received is rupees 1000. Out of this 1000, it has paid off all its obligations, debt obligations amounting to rupees 400, and it has to sell its assets further at 200 rupees. So 1000 plus 200 minus 400 is equals to rupees 600, or you can say 800 earnings profit in total. This 800 total amount increased due to this selling of the business and earning through the assets. 1000 minus 400 plus 200, the 800 rupees will ultimately be helpful in calculating the book value. Now let's suppose the total company's shares are rupees 100. 800 divided by 100 is equals to rupees 8. This 8 is known as book value per share. So let's suppose you have a market price trading in the market as rupees 10. 10 divided by 8, it becomes 1.25. That means your PB ratio or the price to book ratio is 1.25. Here means higher the PB ratio, more would be the value of the firm, call it as overvalued. Lower is the PE ratio, lower would be the PB ratio or the value of the firm, call it as undervalued of the firm. In this case, there is one phenomena which needs to be kept in mind. For example, company is having a PB ratio in FMCG sector or in other paper industry or in automobile industry. I can say that these ratios do vary across a number of industries, as I have already told you in earlier ratios. Moreover, there is also a point that in case if an investor wants to study from the objective or from the mind of that whether the company's shares are skyrocketing increase or showing rapid increase or not. So if the investor wants to know this fact, that why and how the share prices are increasing rapidly or at a remarkable rate, it has to analyze price to book ratio, because this is the only ratio which tells you that why the share prices are being skyrocketing without considering any asset base. Let's take the case of panic selling. Panic selling is the phenomena when sellers try to, under the consideration of fear, they try to sell their shares in the stock market with the, you can say, anxiety, with the consciousness that the prices may down in the future. So due to this panic selling, many industries, many companies have suffered. Let's take the case of Yes Bank. Yes Bank price to book ratio has been dramatically reduced. It has been reduced to 1.14, which is almost negligible. On the contrary, let's take the case of DMart, a very popular mall. It has shown its price to book ratio worth rupees 22. So one must consider this factor also. Next ratio is dividend yield ratio. When I'm going to say dividend yield, it means dividend upon yield. Whatever the dividend paid to the equity shareholders after paying dividend to the preference shareholders, whatever the leftover is remaining to the equity shareholders divided by current stock market price. It shows that how much dividend is, how much return is ultimately going to the equity shareholders after paying its obligations in total. So in this, I'm giving you example. For example, you have invested rupees 100. If you have invested rupees 100 and after a year it remains 100, what would you people say? You people say that the investment is not at all worthy. It is not at all worthwhile. That means you are considering it as of 0% return, because 100 and it is still in 100 terms, there is a 0% increase. That means you people will never judge this investment as valuable one. But you have not at all considered the dividend aspect. On the other hand, if I am going to say that on this 100 you are getting a dividend of 4 rupees per year, that means there at least 4% return are given to you. So these returns must be accounted for while valuing your investments. Don't see ever the capital appreciation part in isolation, but you should also consider the dividend part as a whole as a part of its return. So both capital appreciation and dividend part, that is return part, should be taken into consideration by the investor. Next ratio is, that is debt to equity ratio. Very important ratio. Debt to equity means the total debt divided by total equity. It means that higher is the debt, more levered, more financial leverage is the firm. The lower is the debt, lower financial leverage will be carried by the firm. It means that when the company is having high debt, that means company has raised its money or funds from the outside sources, not from the internal finances. It means that it doesn't consider to be bad, because if the company is having its sources from outside, raising its funding from outside, doesn't consider it as very bad, because this debt gives you an option to pay the interest to the outside parties, and when you are going to pay interest to the outside parties, you will having a tax benefit, and this tax benefit will ultimately provide you the option to influence your P&L statement of your company. So on one point, I can say this highly levered firm can provide some financial advantage to the company. But all in all, I can say high PE ratio, high ROE, but high debt equity ratio causes a red flag situation. This red flag situation indicates a danger sign. It means that company has not only relied on its equity part, but high reliance on its debt too. On the other side, if this debt equity ratio is low, that means company's financial position is quite strong, quite favorable, quite worthy. Moreover, coming to the next ratio, which I am going to tell you, is the current ratio. In this quick ratio, that is acid test ratio, is also holds very much importance. Called it as, you can say it acts as basically financial diet drill, which ultimately helps the company to manage the sudden drop in its cash flows. Quick test ratio indicates the quick assets divided by quick liabilities, means the assets which can be quickly convertible into cash or which has the ability to strong its liquidity position. The higher is the quick ratio, the better it would be. But on this ideal standard, it should be 1:1. That is acid test ratio. Next and last is the earnings per share. Now, what does this earnings per share? E for earnings, E for equity, which I am going to explain to you, is that whatever the money has been paid to the debenture holders in the form of interest, or preference dividend in the form of preference shareholders, or equity dividend in the form of equity shareholders. So after paying interest and preference dividend to the preference shareholders, the leftover part, the remainder part, belongs to our equity shareholders. And when this profit, remaining profit, is to be divided by number of weighted shares outstanding in the open market or in the balance sheet of the company, the per share value of the earnings, call it as EPS. This version, which I have already told you, it is called basic earnings per share. On the other hand, it can be diluted earnings per share. Diluted means one must take into account the dilutive instruments, for example, stock based compensations, dilutive instruments, convertible instruments, warrants, share warrants. So these all aspects, if considered, becomes diluted earnings per share. Investors should consider both basic as well as diluted earnings per share. Apart from these, there is one also crucial indicator, that is gross profit margin. Now what does this gross profit margin is? GP, gross profit divided by sales into 100. It is very simple ratio, but it has some obligations or some, you can say, crucial intricacies belong with it. For example, take the case of a company who has its seasonal business. Now, seasonal business means the company can have dramatically high returns in the case of its a particular season and dramatically low returns if there is no season. So how the investor can compare this performance? Investor can compare this performance through its fourth quarter returns. These fourth quarter returns means the company has to compare its fourth quarter return with the previous year fourth quarter return, so that it can judge that how much relative is the company's performance is. The company's performance has to be judged through several these indicators. So these are all the ratios which I have discussed with you. In the last, I would like to conclude that although the fundamental analysis should be taken by the investor, the careful, the meticulous investigation of this analysis is very much desirable, very much needed, because it provides a bird's eye view to all the investors to analyze the solvency position of the company, liquidity position of the company, financial stability and profitability of the company. Moreover, since these ratios are highly dynamic in nature, I would not ever advise you all to go to these financial ratios and compute these financial ratios in a year at only one point of time. I would suggest you to ultimately calculate these ratios once in every quarter, so that you can have a dynamic viewpoint from this analysis. Moreover, one should not rely on only one ratio at a point of time. Rather, one should consider this bundle of ratios in an integrated manner, so that in its entirety it would provide you a logical viewpoint, a rational viewpoint. Thank you.